Welcome to our first digital version of our quarterly market wrap-up for quarter 2 2025. We've been given feedback every now and then that whilst the content we put together in our market updates are very useful, engaging, thought-provoking, people struggle with finding the time to read the details of the content and had requested that perhaps we could give a digital version a go. So here we are at the Sequoia Studios here in Sydney, and Max and I will come to you and present digitally what we'd normally put together in writing. So as we wrap up the second quarter of 2025, it's a good time to take stock of the key developments that have shaped financial markets both here in Australia and around the world. Globally, markets have been navigating a complex environment marked by shifting central bank policies, uneven economic growth, and ongoing geopolitical uncertainty. The US Fed's evolving stance on US interest rates, China's slower than expected recovery, and the continued tensions in key global regions have all played a role in driving volatility and shaping investor sentiment. Here in Australia, the Reserve Bank has continued to balance inflation concerns with slowing economic momentum, whilst housing and labour market data offer mixed signals about the near-term outlook. Equity markets have responded with cautious optimism, while fixed income and currency markets have seen a renewed attention as investors reassess risk. In this update today with Max, however, we'll look at the main market themes from April to June of 2025, assess the performance across certain asset classes, and provide some forward-looking insights to help inform you and your financial planning decisions for the months ahead. Max, what a quarter. What a year. It's been a ride, and almost fair to say the playbook can be thrown out the window. It's a weird sensation the past few years just don't feel normal. Beginning with COVID, the news of high inflation leading to high cost of living, wars on every corner you turn, tariffs, artificial intelligence taking jobs, climate change, all these things have just left people mentally exhausted. Can you begin by explaining how we as money managers are able to go beyond the media narrative and process all this into our decision-making processes?
Yeah, thanks, Zaheer. Look, I just want to start off with one very basic fundamental principle we manage money by, and that's to be steeped and grounded in fundamentals always. Personally speaking, I try to keep away from the chaos in the media, which is contradictory at the best and the worst of times. And we'll talk about it today in sort of some detail, but we'll talk about the first principles that we invest by. But there's only one way to keep your senses, and I love to keep my senses when we're thinking about the markets and investing people's hard-earned money, and it's a privilege to us to be able to do this on behalf of our clients. So we don't take that lightly, and it has to be done from the first principles. It's values-based, and I hope that we are demonstrating that to clients. Clients should be fairly well placed through how we've been managing their portfolios. I like to say that the greatest test in our illustrating to clients that we are sticking to our values is to see our behavior, for clients to see our behavior during market chaos. So what do I mean by that? Whenever there's a market panic, and in recent times there have been few, most recently in early April due to Trump's tariffs, which we'd been talking about for a while, leading into it, we didn't make any changes to the portfolios. In fact, we were making changes last year. So let's just roll back to what we were doing last year. when markets were going all gung-ho with tech stocks, we were taking profits all throughout last year. We pivoted into India, which we'll talk about, way ahead of the market a few years ago.
2023.
You remember that?
Yep.
That was a contradictory call. We got out of China and we went into India. We made fantastic gains, but we took profits last year in India. We did the same thing with technology. What did we do with those profits? We put those profits in what seemed common sense to me, high interest-bearing, investment grade quality credit, which has been paying 6-7% across our exposures. You don't have to sweat the portfolios too much when income-bearing securities are delivering 5-6-7% per annum, which would have been equity return all throughout last decade. Now you're getting that in safer asset class of credit. So that's where we were parking our profits. And so what have we done in recent times? We've actually been underweight growth all throughout last year. And if anything, we're actually leaning back into growth. And we'll talk about that. We're tilting back into growth. What does that mean? Buying more shares. Now that's again a contradictory call to the market, but there are sound fundamental reasons behind that. We will go through that hopefully in some detail.